Hi, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, as you know, we have seen very volatile markets, maybe seeing a little bit of a pickup recently. But of course, the broader equity markets are very headline driven. Of course, the news that is really driving the asset classes are what the U.S. Federal Reserve is going to do in terms of raising rates. Will they be very aggressive or not that aggressive? But the one sector that continues to outperform, and that's why I wanted to bring an expert to you on this, is, of course, energy. So, with that said, let me bring in our guest. He is the Director of Energy at Raymond James, Jeremy McCrea. Jeremy, great to be able to catch up with you and kind of really understand where the sector's at right now and where we might be going. So, thanks so much for your time.
Yeah, thank you for having me. The quick of it is we are in a multi-year bull run. The energy crisis that's emerging here is becoming more and more evident here every day that we go on. Between natural gas, what we see for oil prices, what we see for coal, and a lot of these fossil fuel type energy sources that we've really been lacking in terms of developing here over the last several years now.
Yeah, and you know what? I think that, a lot of people woke up recently to the shock of the obviously the higher oil prices, nat gas as well. Really maybe obviously exacerbated by the war in Russia, but it was long developing prior to that. But for people who are just kind of getting on the bandwagon, because even if you take a look at the equity flows, there's still a lot of the generalist money managers who aren't even in the sector to the degree that they might end up being in the sector, which means a lot of money flow, which means stock prices moving higher. But can you just step back and describe to people fundamentally why we're in this position?
Yeah, I think probably one of the biggest reasons why we're in here is lack of new supply that's coming on here. If you look at demand, it really has only moved up a little bit marginally here. But one of the biggest things that we've seen over the last several years is this narrative of peak oil, peak oil, peak oil, peak oil demand. And what that is essentially meaning that we are transitioning away from fossil fuels at a very rapid pace. And a lot of the executives and projects that would typically come in, I'm talking like the mega projects, offshore oil sands projects that typically need 5 years worth of planning, approval, and then another 5 years of building, and then be on stream for another 25 years after that. There's a lot of executives saying, if we are actually maybe reaching peak oil, why are we building this project that's going to last for 30, 40 years here? And so you've seen a lot of that capital not go to go to work, and that's all over the world, not just in Canada here. And so as a result, we're looking at this supply deficit that is suddenly emerging here awfully quick. You go through 2 years of COVID that somewhat masks the situation, but as soon as you start to come out and things are rebounding, here we are. You look at China, for example, that was just shut down, for a good month not too long ago, and it's still the demand is not quite where it is, but you can start to see the supply issues really starting to catch up here, even before the whole world has opened up here now.
Mm. And then let's add in the war in Ukraine and the impact that that's having.
Yeah, so that just quickened the shortage that we're seeing worldwide here. You look at we'll take the EIA. They spend a few $100 million on trying to understand and forecast the markets here, and so just using their assumptions, they're expecting Russia to be producing closer to 12 million barrels here by 2023. That has been now revised again with their short term outlook down closer to 9 million barrels here. So that's a deficit of 3 million barrels, or about 3% of global supply here, which when you look at who can make up that shortfall, there really isn't a lot of countries. And I think it goes back to what we saw with OPEC yesterday, where they increased the quotas for all the countries. But you start looking at the majority of these countries actually can't even meet those quotas that we have. And then you start looking at the quota of even Saudi Arabia at 10 million, 10.5 million barrels of what they can produce. You really don't have a lot of spare capacity anymore. They have only barely produced over 11 million barrels very intermittently. So you really are coming up to limits in terms of what OPEC may be able to supply as well.
Yeah, it's fascinating, particularly because when OPEC Plus yesterday came out and raised the production targets, the price of WTI really held in. I mean, it was trading in the green. I don't think it ended up in positive territory yesterday, but nonetheless, nobody was moved by the announcement. And I suppose in part because most people know that in past increases, they haven't been able to actually meet those targets. We're going to take a quick break. We'll be
Mhm.
right back. Jeremy, I just want to pick it up in terms of the supply deficit globally that we're seeing of oil, and we can also, of course, add in maybe nat gas. I'm not sure, but the reason why I'm asking is because you started out by saying we have a multi-year investment horizon. It sounds like for owning oil and oil stocks, but um, you know it probably surprises a lot of people. I don't think that's been the narrative. I think we always think that Saudi Arabia has plenty of oil. Can you give us a bit more detail in terms of whether they do or they don't?
Yeah, and I think that's a bit open for debate here. You will have all walks of different investment communities say, they can produce more than 11. There's no history of them producing more than 11. If you look at why they're not making up for the shortfall for some of these other countries, why aren't they? And I think that's a lot of speculation on, do they really do have the capacity or not? And you see that with a lot of the other countries in terms of, here's your quotas, and you guys, these countries haven't met those quotas for quite some time. And I think that's what's putting a little bit more doubt in terms of, is there really the spare capacity that is expected out there? And you're starting to see more and more research come out that suggests that, what, maybe they don't. And unfortunately, the way you only find out is if prices suddenly spike and that production doesn't come on. But in the meantime, you do have those spikes. There's probably more risk to the upside in terms of commodity prices, or in terms of crude oil prices going up versus going down here, just given that margin of error that we're looking at spare capacity now.
And again, just keeping our eyes on the supply side because that's key and critical, and that's the reason the lack of supply is why we're seeing WTI over 110 bucks. But what about the U.S. shale players? What's the ability for them to come back online?
Yeah, so this is one of the biggest reasons over the last 10 years here why oil prices have been relatively comfortable range in that 50, 60, $70 range here. And it was because US shale was able to make up any shortfall that OPEC had very quickly. And the problem that we have now, though, is a real shareholder activism that says we need to start seeing some profits here. And there's a lot of struggle that says instead of seeing you guys grow more, we want to see a return of capital. And a lot of the management compensation packages now have been restructured. So they're rewarded not on growth, but more on free cash flow, more on returns. And the thing that really helps returns is if you don't grow, if you're not expanding new pipelines in that. So management have an incentive to really just kind of pay bigger dividends and buy back stock. But the other issue, though, that's going on is you really just do have a lack of supply and labor here. To try and get an additional rig, to get the steel for that rig to drill, just given kind of the inflationary problems, and just finding good qualified, rig hands here because, it goes back to that narrative of peak oil. Typically, rig hands are younger generation, and if you're trying to entice someone to come and work on the rigs and they're looking at a 40-year career and they're saying, I'm not quite sure oil is going to be around here in 40 years. Why do I want to come do that as a career? So you really are running into a lot of logistical issues trying to get new rigs to work here as well too for the shale play.
When we think about Canada's role in the global oil story and or supply side, and when we think of our friends south of our border and the need that they really do have to combat their high oil prices, where does Canada fit into that?
You know what? As I think the we've been really focused on the ESG of Canadian oil here. Just really focusing on the environment, social, the governance. But I think there needs to be another S added to that ESG, meaning security here, that we really haven't talked about quite nearly as often as we probably should be here. And unfortunately, just given our egress and pipelines out of Canada, we don't really have the ability to help out, our U.S. friends and anybody overseas here. Just, there's marginal supply that we could probably increase production by about 5% here, but we really are limited in terms of what we can really do on a world stage here now.
Is that a missed opportunity?
I, I, I think very certain it's a missed opportunity, and I think it depends on which side of the aisle you're looking at here. But if we're looking for, who's going to supply the marginal source of oil to, a country in Asia here, is it going to be Saudi Arabia or should it be Canada? And I think there'll be a lot of people who would say, well, it should be Canada, but these are the debates that we have here, and sometimes it's difficult to have those conversations.
Yeah, no, absolutely. All right, we're going to take a quick break. When we come back, we're going to kind of put this together in terms of the investment themes we should be looking at. We'll be right back. So, Jeremy, when we put the supply demand dynamics together, what are the themes that you're talking about and thinking about in terms of investing in the energy sector? And I personally do focus a lot on oil, but I know from the top of the show, you're saying that nat gas, that we could see a crisis in nat gas as well, which I'm surprised at. But how should we be thinking about investing in the space?
Yeah, maybe I'll just talk quickly about natural gas here. For the most part, natural gas is in Canada has been trading around, $2 an MCF here for what we have in Canada called ACO. And for it's been that way for the last several years. And then the marginal cost to bring on new gas here in Canada is running around $2 like about $1 here. So there's some good profit margins that can be made even at $2. And our price is based off of the differential from the US NYMEX gas price. And what's interesting here, though, is gas prices have quickly moved up closer to that $8-9 range here, which has pushed ACO gas prices up as well. But NYMEX gas prices are following a little bit more of a global natural gas price here. Like you look at what they're paying in Europe and Japan, you're running closer to $30 an MCF. And a lot of the reasons why we're seeing these two prices converge is somewhat like oil. When it becomes a little bit more tradable, prices will find a global benchmark here. And we aren't there yet, but as we have more and more LNG projects be built off the U.S. Gulf Coast here, and ultimately eventually Canada, that's you are going to find that global medium and where gas prices are going to start trading here. So that's why we've started to see natural gas prices move up quite rapidly.
So, but what's key and critical here is that we actually do develop the liquefied natural gas plants, correct?
Yeah, so it's important here just to get our resource out and just in terms of profitability. But one of the issues that goes back to the oil, why we can't produce more natural gas, is trying to find rigs, trying to find crews to operate these rigs, and really what we have, where most of the natural gas here in Canada is coming from, is in the Montney, and you do have logistical pipeline issues in that region as well too. You also look at what's going on in BC here with the Supreme Court ruling with the Blueberry River First Nation group, in terms of basically a suspension of all new well licenses in BC. And talking to a number of U.S. investors, they hear regulatory stoppage here, and they effectively just say, we can't invest in BC here. And so that's what a lot of these BC operators are just kind of struggling with, is if we can't get investors into our company, maybe we should hold off on spending more money on rigs here as well too. So there's a lot of nuances and factors going into play here right now, why we haven't seen new supply come on, especially for natural gas, given how profitable it even is for some of these natural gas players.
Right. So what does that mean then in terms of where the money managers are investing right now? And I'm curious as to the flows as well. That's always important to take a look at the money flows into certain sectors.
Yes, so we do a few different studies on the money flows as well too. Totally agree with you. And so just a couple of stats here. What we do is we look at the 13 Fs, the alternative monthly filing reports every quarter. And what we found is if you look at every fund that's invested in a Canadian energy company over the last 5 years, about 6,400 funds, What are those funds buying today, and what are they, what are they looking at? And what we can see for the mid cap space, so this is the non oil sands companies, there's about $1.1 billion worth of buying of these funds here, of the mid cap names. And if you start to break down where those funds are coming from, about half of that is still energy focused funds. But you're really starting to see the generalists start to come in more so than any other time that we've seen in the last, 3 years here. This is the first quarter where we start to see them step up. But given how much they had sold over the last during COVID, it still hasn't made up nearly as much as what they've come in here recently. So, there is still a lot of pickup in trade, and you can start to look at, some of the other factors. What's the turnover funds buying? So you've had the hedge funds come in quite a bit, but you really haven't seen the low turnover funds. These are typically your pension funds. They still haven't moved in, but you can start to see that start to change here. So your long term, pension type money is really starting to look at energy, saying, you know what, maybe we do need to consider security as part of, a balanced approach to our investments. And that's why I think they want to start to come into the sector here a little bit more now.
Okay, we'll take a quick break. When we come back, we'll get a little bit more detail in terms of where to invest. Jeremy, just to pick up on what you last said, it's so interesting to me to see, really pension funds and money managers who, sold the sector and sold it so hard because of ESG. And now, to your point, the importance of recognizing how important energy is to all of us still, and likely will be for many years, i.e., the security side of energy. Having said that, though, let's talk a little bit about specifics in terms of the areas within the energy sector. There's so many different specific subsectors within energy you can invest in. What do you like right now?
Yeah, honestly, right now, you look at some of the big cap names here in the Montney, between the natural gas theme here and what we're going to see in terms of LNG being built out on the West Coast. It really does set up a fundamental reason why you could see natural gas prices, quite a bit higher than the cost to bring that gas on. And so you talk about profitability is really the name of the game here now. And, who are the most profitable companies? And up markets, down markets, those are the names who are going to be around here for quite some time. Everything works in this market where the commodity prices are, but as we've seen before, commodities can be quite volatile. And as long as you're in those most profitable names, those are the names that really should come to light. So I think probably the logical one here right away would be Tourmaline. And, it's the biggest natural gas operator in BC, and just in terms of, direct exposure here. And you look at what's being built here on the West Coast in terms of LNG Canada and the ability for Tourmaline to supply gas, and what we've seen with them supplying gas down into some of the other LNG terminals down into the Gulf. Instead of them getting, $7-8 gas, they're likely to get more Asian type prices here. And you start looking at what they're going to be able to pay in terms of special dividends, even just bumping the dividend yesterday. There's likely to be many more dividend bumps here to come here.
And what about from a more oily perspective?
Yeah, in terms of the oily perspective, there's quite a few names here that work. One of the more logical ones that the guys are flocking to are Enerplus and Whitecap, and for good reason too. You look at the economics that both these companies have in their portfolios. You're looking at payouts on your wells within 4 to 5 months here, but more importantly, you're looking at 2 times payout within a couple of years. And when you look at that 2 times payout, you're really where your profits are. That 2 times payout a few years ago would have been closer to 10 years. And so it just shows that, if companies are actually looking for more free cash flow, it actually, in a weird way, you get more free cash flow by spending more. And when you look at the inventory of Enerplus and Whitecap and their ability to really go spend, pay down debt, buy back shares, increase their dividend, they really do have a long runway here in terms of what they can really accomplish. So I think you really could see some, excitement here in terms of, as investors really start to understand this free cash flow ability for those 2 companies, Enerplus and Whitecap. You're likely to see more investors come into those stocks here near term.
Got it. And just one thing to talk about as well, because you do bring up the volatility of commodity prices. I'm such a big believer, when WTI moves higher, the stocks move higher, lower, stocks move lower. But there's a much bigger picture here that we've been talking about today, and I think that that still holds in terms of the structural deficit of the supply of oil. But if we do get some type of resolution in Ukraine and Russia, and we all hope we do, I mean, what would you say to investors moving into the space today? Because we'll probably get a hit to the downside, is my point.
Yeah, you know what, you really could. But the one thing is, we may end sanctions on Russia, but just given the ESG themes with companies, I think a lot of them are going to have a struggle to go actually back invest in Russia. And I don't think you're going to see Russian production ramp up nearly as quickly as back to where we used to be here. This still goes back to an energy deficit that we've seen for quite some time that's been building, and the Russia conflict accelerated some of that, but didn't erase it. I think maybe just one of the things that could really excite more interest in some of these Canadian names here is the M&A theme. And you talk to a number of executives, and we always do this, semi-annual survey. And we got about 60 responses back just recently here, and there's about the most of the executives thought there's going to be about 3 or 4 major public M&A acquisition announcements here in a field of about 40 names. So there's still going to be some good M&A, and I think anytime this M&A happens at a premium, it's going to excite new investors back into the market here.
Okay, Jeremy, we'll leave it there. Great to see you. Thank you.
Catherine, take care.